Hey there, Tristan Schifo from Purpose Advisory. I wanted to share a handful of thoughts that have come to my attention over the past few weeks as I've continued to dive into my research on the macro economy, what's happening in the stock markets, the property markets, the crypto markets, and everything in between. For many of you who know me personally or who I work with, this is also an important an alarm bell of some things that I've been coming to conclusions of, which I want to alert you to and make sure that you are aware of and you're therefore paying attention. And so I've titled this presentation, It's Time to Stop and Consider. To kick off everything I start with today, I'm going to share a lot of relevant, meaningful information that I hope will help you make practical decisions. All the things I share here are generic in nature. They're not specific to you and what you should do. I'm not wanting anyone to take rash action on the back of this, especially since I'm intending to be relatively alarming in the news and the information I'm sharing. If you want to have a chat with me, please reach out, especially if you're a client, arrange a meeting. I'd love to sit down with you and talk through what changes we can make to your portfolio. And if you're looking for some advice, reach out to myself or one of my colleagues in the industry. Generally speaking, I would say that I'm an optimist. And over the past year and a half, I've tried to challenge my view on how the sentiment of financial markets will move. I have always had this view that sometime around 2025-26, there'd probably be another big GFC type event. I like to think in sort of 20-year cycles, I guess mapping to maybe an 80-year macro cycle. And very loosely, you can pin some rough time frames. So I always had in my mind at some point in the future, there'll be a rough spot. But at the end of last year, being quite involved in the crypto market, which many would argue is a very natural market. It's not being suppressed or influenced by governments or by policy. It's very unregulated. And as a result, it runs very efficiently based off demand and supply. In other words, it becomes a really effective canary in the coal mine for what's going on in the macro economy. It's a smaller market, so things move very quickly, and it's also very volatile, so they move very strong. Now, I'd seen a lot of growth throughout the year, and then we started to see some really strong pullbacks in November. That alerted me to something going on, and I needed to work out what was it. And so I went on my personal journey of deep diving into the pessimistic side of the economy. People like Michael Burry and Harry Dent, who are regularly referred to anytime people talk of economic bubbles, prices being too high, were just names to me. I didn't know their thoughts, their backgrounds, nor their theories. And so around December, January, I started researching all of these people on the screen, many of whom I genuinely respect. Ray Dalio, possibly the most successful hedge fund manager alive. Jeremy Grantham, one of the most well-respected long-term investors. Michael Burry, very successful in picking the GFC, making money by shorting the market during the GFC. Felix Zukauf, who I respect immensely as just an amazing mind understanding macroeconomics. Interesting TV personalities like Kevin O'Leary, who are quite successful investors, Mr. Wonderful. And then a vast, I guess, diversity of different opinions and perspectives, all converging on a general sense of concern. What were the messages that these people were sharing? Well, it was mixed, but you were hearing things like, we're in an everything bubble. There's no one particular asset that's up. They're all up. Everything's overpriced. Speculation is too high. I heard of a corn chip that sold for more than $20,000 on eBay last year. There were meme coins. There was GameStop, all these assets that were worth nothing, and all of a sudden had 9 zeros on the end of them. Crazy. This is a super bubble like in 1929 and in 2000. A 50% crash is to come. And that's when you start to wake up. Early 2022 will be the beginning of major crash from 45 to 90% on US stocks. That was Harry Dent. 90% is quite significant. I still have not come on to believe that, but that's the way he sees the world. US Fed, as in the Federal Reserve action in 2022, is likely to crash the market. We'll see negative returns for the US market over the next decade. And even Ray Dalio was quoted a few years ago as saying he believes a time is coming where we'll see a sideways decade. In other words, there'll be a point at which the market will drop and it'll take 10 years to get back to where it was. Now, that was the backdrop. And after spending time getting my head around the thinking of all these different perspectives, I needed to deepen my understanding. And I spent a lot of time educating my clients and producing some content around what is inflation, what is the Fed, how does the Reserve Bank in Australia and in the US manage monetary policy with interest rates and money printing, and how does that influence the economy, and why are they so influential? Why does your stock portfolio get so affected by what the government does? And what's likely to happen, obviously. And so something that I published in a couple of my videos and something I shared with our clients was effectively this summary. This is how I saw things, and I published it in January. I thought there was two main scenarios that we were going for. In both scenarios, I thought there was going to be a correction. In the bullish scenario, between 10 and 25%. In the bearish scenario, i.e. the sort of more negative scenario, 25 up to 50%. I was leaning more towards this bullish scenario for a number of reasons. I thought there was an 80% chance that we'd see the pullback. Inflation, which was the big issue at the time, would drop back to a bearable level. I was hopeful of that, and hopefully stay around that 4%. Still higher than it should be, but where we can tolerate it more, rather than in the US it hit above 9. A few other countries it hit above 10. Australia hit above 5. Unemployment might begin to rise, but that ultimately the governments of the world would change their tune, stop becoming so aggressive in trying to suppress inflation, and start to be like, whoops, we got to start supporting the economy. In other words, they drop interest rates and they start printing money again. And my theory was that would, as most people would expect, fuel future growth and another leg of growth. And by this point this year, by around August, September, you'd see, I guess, your correction, your pickup, and you'd see markets run. The bearish case was a bit different. It was that after 6 to 8 months of increasing interest rates, cutting back money supply, being very what's called hawkish, trying to suppress the market and really hold down market growth, that you'd see this correction, but that you wouldn't get the reduction in inflation that was desired. And sadly, that's what's happened. So what I put as only a 20% probability has largely played out, not entirely, but largely. And so we're now in a situation where we still have very high inflation across the world, and there's more issues that have come up. It's easy to point to the war in Russia as the main change, but that wasn't just it. A lot of things panned out different to how I had anticipated, how many of us even knew. This is a very new world that we're in. And I'm going to talk to some of the facts and the details of why that is throughout this presentation. So I'm now recognizing that this second scenario was probably more accurate. And so I've updated my perspective. Beforehand, though, let's just look at what's actually happened in the past 8 to 9 months. So we've got the US market here, the Australian market here. We've got Bitcoin, the crypto market, and we've got property markets here. So the US market pulled back about 23% to its bottom before it's rallied over the last month and a half, pretty much up until this weekend. I'm recording this on the 20th of August. It's come back 15%. Important to note, if you go down 23%, you have to go up by more than 23% to get up to where you were. You can't just minus 23 and then plus 23 and have it zero out. It's not how mathematics works. The Australian market didn't pull back as steeply, but it hasn't corrected as strongly either. So in a similar sort of point. And then the crypto markets have pulled back much steeper. And as you can see, it started earlier, November compared to January. And correction's been a bit stronger, but still it's been up and down. Property's been interesting because you don't get a graph for it, sadly. But if you look at the quarter-to-quarter movements, you see really strong corrections, 5-3% in Sydney and Melbourne. Brisbane more moderate. Adelaide and Perth still seeing growth. And the year-to-year, in other words, over the last 12 months, Sydney and Melbourne are pretty much flat. In other words, whatever growth there was has sort of curled over. Meanwhile, Brisbane, Adelaide, and Perth are still quite strong. So what you've seen, especially in the crypto markets and then also in the stock markets, has only just started to flow through to the property markets, which makes sense because the interest rates have only started to really kick in early. Important to note is that stock markets are affected by people's emotions. When people hear that there's rates going to be increased in the future, everyone freaks out and then they act straight away. They buy, sell. It's really quick and easy to buy and sell stocks. So changes happen sooner, even more so in crypto because, like I said, there's less restriction or friction. Property sales take a long time to take place. there's less emotion involved because it's such a big, bulky purchase, there's more costs. So you don't tend to get these reactions until later in the piece, until the interest rates start really ticking up and people paying an increased repayment. They go, oh gosh, can I afford this? Maybe I should sell the property or downsize our home or whatever it happens to be. So we're definitely at this interesting point. And if you look at it, some would say we've finished the correction. The scenario one, Tristan, played out. You've had your 10 to 25% pullback, and now you're looking to run up. I would like to think that's true. There is always the probability that that is true. There's been some strong growth in the US market, strong in the Australian market. Crypto still hasn't seen it just yet, but the property market didn't get hit as hard as it could have been. So I think there's the seeds of a possible optimistic future ahead. However, I want to share with you why I think now is a good time to stop and pay attention and decide for yourself what is going on and what does it mean for you. So here's my new assessment from today looking forwards. I would say that the bullish case now has a 30% or less probability of playing out in my mind. I still give it some credibility. I hope it's the case for all of our sakes. I don't think it's most likely now. I think that it's possible the 6-month correction is over and we're ready for growth. If inflation can fall quickly to 4 to 5%, both in Australia and the US, governments will then probably decide to support the economy. They'll probably do it if they think that the economy is hit hard enough. Now, it's complex because governments normally look at unemployment as a major issue for needing to support the economy. We have great employment levels. It's almost zero unemployment. That's not the problem. The problem is that people aren't getting high wages. So people have 2 or 3 jobs. They're employed, they're doing a side hustle, they're working 3 days here. But it doesn't mean that they can afford their lifestyle. So in the past, unemployment was such an important factor because you either had a job full time or you didn't. So unemployment was a great measure of how many people are hurting versus not. Now, unemployment levels kind of doesn't matter. If you want to work, you work. If you don't want to work, you don't. You get the dole, or you live off your savings, or you travel overseas and work from abroad. There's so many ways to make money and it's more flexible, but they don't all pay a solid salary. It's not like your full-time 9-to-5 type arrangements that we used to rely on. And so in some ways, our mechanisms at what we assess the market to be is a bit broken. And the government saying, hey, unemployment's doing okay, we're not going to support you just yet. So I think that's unlikely that we're going to see this pivot of the government saying, hey, we'll just support the market now. Let's drop rates and print money and get the show back on the road. But it's possible. I think you would also need to see profitable growth sectors re-emerge. The AI sector hopefully start infiltrating into various industries, cut costs, produce better quality products, prompt more business opportunity. You also need more subsidies. I don't believe that there's adequate investment potential on the market. I don't think people are cashed up ready to invest in high risk ventures. I think we're all looking for a handout. We all want government funding. People want to get on a government grant. People want to get subsidies for new investment. New business startups want to get grants as well. We're all very much leaning on Big Brother to try and make the economy fuel forward, and we would need that to some degree. And that's a policy decision from various nation points of view. I think you need these global political tensions to ease. There's so much friction, and as a result, destruction of wealth that takes place when you get these political tensions. It leads to more nationalization. Everyone has to sort of stop doing trade. There's more tariffs, more embargoes, less free trade, less opportunity, more concern, and just business doesn't flow as well. You don't get as much growth. And you need improvements in consumer confidence. We don't have a lot of consumer confidence at all at the moment. And I'm not just talking about the market cycle. What I think is probably the more likely scenario, about 70%, is that we're only midway through a larger recession. And we're likely to be in this season of stagflation. I won't go through these points in too much detail, but ultimately the opposite, that inflation won't manage to drop to what it needs to be. Unemployment will stay low, but wage growth will stay flat, and that there's a deeper recession or maybe even a depression to come. Depression is a big word, but I think there's likely a recession of some sorts to come. Now, I don't believe every asset is going to get hit hard. Some assets will fall apart even more than they have. Some will flatline and some will actually grow. But I believe on the whole, it's likely that we're going to see some more downturn. So that's my general concern. If you're interested to understand why I think that and to get into the detail of it, I encourage you to listen on. Otherwise, reach out, give me a call, send me an email. I'd love to have a chat with you and see what we can do about it. So diving into it. So what is stagflation? I brought up this idea just beforehand. It's a very interesting idea, which theoretically is meant to be impossible. Some people say that it can't happen because what it means is you've got poor growth, stocks, asset values, properties going down, but the prices of things generally going up. Sounds a bit weird. If assets were going down, wouldn't prices go down as well? So that's how the theory would run. But in practice, it can happen. There's various reasons why. And we are in that type of era at the moment where we have high inflation, higher than desired, and yet asset values are decreasing. This weird scenario. It's where people don't have enough income and prices are going up and they can't sell their assets because they're all worth less than they had. It's a bit of a rough situation. We have had in the past. It's just not a common thing. Back in the 1970s, people refer to this time as maybe somewhat comparable to today. You could also say the 1940s was quite comparable. There was this really, bold American bank manager his name was Paul Volcker. And he decided that he was going to slay the stagflation dragon by raising rates. So you see what he did here. He took the interest rate from about 5% right up to 20 odd percent, which is remarkable. Imagine the base interest rate being at 20%, maybe your mortgage rate at 22. That's remarkable. Some of you might even remember that. Similar things happen in various parts of the world, sort of to follow suit from his lead. He set the tone, and in many ways, he slayed the stagflation dragon. It took a good decade of hard times, and it took a long time for the rate to come back. So you could say it took 2 to 3 decades to really resolve. But it was that bold action that did it. It was in the face of a lot of flack, a lot of pushback on all sides, but he had determination to make it work. Now, most people would say that that type of approach can't happen today. Firstly, they don't believe there's the political will to do that. It's hard to be such a, visionary and bold and courageous. But also that debt levels, global debt levels, are so high that increasing interest rates, even marginally, you see, we've had our highest level of rates dropping and dropping and dropping. Even increasing it this much just recently, the past few months, has sort of been almost too much. There's so much pain in the streets because the higher your debt level, the more that a small interest rate amplifies the impact, right? So that's a little bit of history of what stagflation has been. That's a taster for what I think is to come, this scenario of ongoing higher inflation. So why am I concerned? Why is Tristan concerned? There's a whole bunch of info here, but look, I talked about inflation. It's crazy. Globally, it's really crazy. And there's lots of reasons why it's not just up, but it's probably going to stay up. Interest rates have hiked very quickly and too late. So in the past 2 years, whilst inflation was building, triggered especially by all of the cashing out during the shutdown of the economy. 2020, we had the COVID crisis. We decided to shut down our economy and to pay everyone lots of money. We made a lot of money. That had a lot of flow-on effects, which has ultimately led to inflation. At the same time, you shut down all of your infrastructure, which meant there wasn't as many items to purchase. Everyone still wanted items. They wanted to buy because they had lots of cash, nothing to do with their money. And so they were all purchasing a lot. And you had heaps of demand and not enough supply. And so you end up getting higher prices, higher. And now you have wars and you have nationalization and there's all these other threats. Global debt levels, as I mentioned, just means that you can't tolerate higher rates. Wage growth is very weak. Consumer spending is very weak as well. So although theoretically you've seen more consumer spending over the past couple of years, if you account for increased prices, there's actually been not more spending. In other words, there's more dollars being spent, but not more services being bought. People are buying less and less. It's just costing them more and more because of inflation. That's not a good sign. That means that there's less growth opportunity. Subsidies are starting to end, both in Australia and the US. People are still on loan forgiveness programs or on loan pauses, holidays. Student loans in the US are largely on pause. As a lot of these cash payments over the past few years are kind of like been sitting in people's bank accounts, and they're starting to eat into it these days as their cost of living goes up, but their wages drop. And we haven't really seen the cliff where people don't have enough anymore. And I believe that time is coming pretty soon. Commodity prices. So we've seen massive spikes in oil, as you probably will be aware, food, other types of energy, so gas, also the metals, so nickel and these sorts of things that are useful or needed to build things and keep the world functioning. They've shot up. And that makes everything more expensive, because when one of the foundational ingredients gets more expensive, every other part of the production process gets more expensive, and you at the shopping center have to pay more. That's what happens. And that's not likely to unravel. In fact, if anything, we're likely to see continued commodity price increases. Business failures. We've only just started to see the beginning of it. You're probably hearing in the news about property development companies in Australia going bust. In the US, there's probably a number of sectors that are starting to go bust. You're starting to see mergers and acquisitions, big companies gobbling smaller companies. In China, there's a whole sector of property development that's pretty much on its knees, about to tumble and collapse. Chinese government might subsidize and bail out their companies. We're yet to see how they respond to it. The Western countries might or might not bail out as well, but ultimately there's these implosions taking place. New investments very weak. If you look at the venture capital space, like your unicorns, the sort of like the cool new up and coming companies, the tech startups, there's not many of them around. If you've got a great idea and you've even got a decent team, it's hard to get money these days. You have to already be very profitable, and you have to be able to scale it very quickly and effectively. There's not the free liberal money that was being thrown out in 2020 and 2021. That was associated with the bubbly type prices. And then finally, Australian property. So our property market, as I said, is only just starting to see its early stages of the correction. And some would say that we have a strong property market, especially our capital cities. They're landlocked. There's not heaps of space. They don't have much room to go down. There's always people wanting it. I buy that argument. I'm optimistic to a large extent on quality property. And many of you would have heard me say that. However, a falling tide can sort of sink all boats, just like a rising tide can float all boats. And no matter how strong your asset is, if everything else around it is crashing, it will also be affected. And we haven't seen the real extent of the pain in the property market in Australia just yet. So what are the flashpoints? This is what I'm watching at the moment. So what are the things I'm looking to the horizon for? There's four main themes, and I've said it once, I'll say it again. I'm an optimist, so I don't normally do this. I've spent like 10 to 20 hours on each of these themes, just trying to get my head around it. And a few of them I'm actually genuinely concerned about. The food crisis is the one that's knocked me for six the most. I didn't have any idea how global agriculture worked and how the logistics of things back and forth was flowing. I've been really fast-tracked over the past few weeks of how it does work. And my concern is that from about September, October this year, we're due for really bad harvests across almost all major crops across the world. Obviously, Ukraine, which is the breadbasket of Europe and a lot of the world, has been massively affected by this war. But that's not just it. There's massive issues with fertilizer. There's been a number of climate-oriented issues with, in France, things are too hot. There's water issues, there's floods in some places, there's droughts in other places. You're going to have much less food production this year than ever before in the past few decades, especially per capita. And that is going to lead to a famine of some form. The estimates of what it will do range from, at its worst, between 150 million and 1.5 billion humans who will be forced to be displaced from their homes because they won't be able to survive and live in their local city, village, country. And that 150 million to 1.5 billion people will likely, over the next 5 to 10 years, start wandering towards somewhere else, to Germany, to the US, to Australia, to New Zealand, wherever they can get to. That's staggering. My heart goes out to anyone who's going to be affected by that. And I feel like in Sydney, with the way that my wife and myself live our lifestyle very sustainably, we're probably in the best position, and we've got assets and income, good position to not be so affected by that. But there are many, many people on this earth who will. And that will affect the global markets, and that will definitely affect the way that we need to invest. Something to watch out for. And it's kind of just a ticking time bomb, and it's just around the corner. We're not talking 5 years, not 10 years. It's going to start from as soon as kind of the coming harvest season. The energy crisis, it's complex matter, but ultimately gas and oil are in limited supply. Russia's a major supplier of that. Tensions with Russia at the moment. Don't have enough supply of gas or oil at the moment. We're running low on our stockpiles, and eventually there's not going to be enough, and people are going to still want it. We're trying to go green. Some countries are literally destroying their ability to produce gas and coal and these things. I understand the reasons for it. Makes sense. It maps to our climate goals, but at the same time, it's going to just push the prices of all energy higher and higher and higher into an inflationary environment, maybe with a famine as well. It could be a bit of a perfect storm, something to watch, just to be mindful of. Deglobalization, a major theme. These are big, complex issues, each of these. So this is the fact that 5, 10 years ago, the world was still policed by America. At some point over the last few years, I would say probably the point where America left Afghanistan was just a clear marker of, hey, we're not playing that role anymore. We've kind of failed all our missions up until now, the last 20 years, but we're not even going to try anymore. Let's just let it be. And, the Russia-Ukraine thing happened very quickly after. People are talking about China, Taiwan, whether that happens or not. The point is that America is not the big daddy of the world anymore. There's no one governing all these trade routes, and everyone's having to become more localized. Everyone has to have their own self-sustainability. A lot of island nations like Australia are thinking, how do we get all the stuff that we need? If we're going to have animosity between us and China, what can we onshore? Let's bring our production over here. Let's produce more nutrients, or dig more nutrients out rather. Let's produce more grains and things like that. And that's happening all over the place. And there's heaps of costs associated with that. That takes mammoth investment, both in human capital and in physical capital. And you'll get rewards from that. That'll become a much better world eventually, I think. There'll be more capacity. But for the next 5, 10 years, it'll be a lot of pain, a lot of sacrifice to pay to get there that way. And what it also comes with is a cloistered mindset. Like I said earlier, less trade, less opportunity. And finally, there's the war and political tensions, which goes without saying. Hopefully, there's not too much of that, but it's almost inevitable. As we deglobalize and become more nationalistic, you will naturally have people mongering for opportunity and for a better deal and one-uppers. There'll be less harmony and there'll be more tension. We have to do our best to be loving, human, and wise in the face of that. But economically, you have to expect that it gets more tense. So these are the four major flashpoints, meaning that it's like a gassy room and a single spark could explode the whole thing. So you've got to sort of look around. Where could it come from? I don't know where it's going to come from. I'm just mindful that any one of these four, if not all of them, could happen over the coming 6 to 12 months and could significantly trigger more negative events. Now, I don't mean to make you too concerned. Hopefully, you're not feeling anxious or afraid at this point. One thing I want you to do is to be concerned, but not to be worried. And that's a personal discipline. That's to do with how you respond to your sadness and your own fear. But what I want to do is to alert you to some of the facts so that you can take it away and chew on it. I encourage you, if this is bringing up emotions, make sure that you have a chat with someone that you trust about it. Spend time in prayer and to be able to release these things, or mindfulness or meditation, or whatever your practice happens to be, and make sure that you connect with what you're feeling. Don't suppress it. Don't pretend it's not there. Don't avoid it. Make sure you encounter that experience and allow it to kind of express and manifest whatever wisdom might show to you, because there's probably going to be some wise action to take on the other side of that emotion. So what should you be doing? It's a very difficult question. I'm not going to give you an instruction, obviously, but I want to give some tips. Should you be selling your assets? Well, like I said, I'm not going to answer it directly, but there's probably 6 things that you should look at. I'm going to cover them very quickly. What was your goal when you first bought the stock or the property or the crypto or whatever it happens to be? Will you be selling it at a loss? Are you in profit still at the moment? What would be your objective if you were to sell? Is it to buy back in later, or is it just to de-risk and be off, have a lower risk situation? And will you be on track to achieve your goals without that investment? What else would you have to do to achieve the long-term goal, which is why you took it in the first place? Then you've got to think about what's your view of the market. I've shared a lot of my details of what I'm seeing. You might have different interpretations. A lot of people do. All those sort of naysayers I looked at were very negative initially, and I agree with a few of them on certain points, but I don't agree with all of them on all their points. What do you agree with what I've shared? What makes sense to you of what I've shared? Do you think we'll see more downturn in the short term, midterm? Which assets do you think will go up and down? Because they're not all going to go up strong and not all going to go down strong. When do you think markets will bottom? Was that back in June? Is that yet to come? And when do you think they'll recover? Will it happen quickly or will it take some time? You need to know your time horizon. So how long can you hold the current asset for? If it's going to go down, can you hold through? If you've got 5, 10, 20 years, you can probably afford to take the risk. If you have 3, 4, 5 years and maybe you need that money to buy a property or to upsize or to study or to change business, something like this, or you're just on the brink of retirement, maybe you can't take that risk. What if you didn't get your money back within that 3 or 4 years? When do you specifically need it? When's the soonest you might need it for sure? And when would you hope to sell? These are important things to consider. And then if you did sell, what are the consequences? What sales costs and tax will you pay? How will it affect your cash flow? How will it affect your lifestyle, especially if it's your home? Are you willing to sell a home? How will it affect your emotions? Will that unsettle you? Will you find the process of trying to sell and buy in, will that just ruin the next 3 months of your life and derail you from other projects like being a parent or being a focused worker? What are the personal implications of the decision? What are the alternatives? So if you are to sell, does it just sit in cash? Like, where does it go? You ideally need to have an alternative that's better than whatever it would have done in that asset. And then how hands-on do you want to get? So if you're going to engage in the process of taking some action, maybe selling, maybe pivoting, maybe reallocating, then if we're going to do that now, are you going to do a reversal on the other side? Are you waiting till markets come to a sort of more stable point before you pivot back? And how will you know when that is? Like, what will be your decision criteria to pivot back? Are you going to be doing it yourself? Do you feel confident? Do you feel that you have the skills to do it? Or do you need to employ someone's help? And if so, what's the cost associated with that? So there's heaps of questions there. That's why I can't tell you what to do. I can't even, come up with a solution for each of my individual clients. We need to talk it through and think it through and really prompt and lead you to make the best decisions for each of your individual assets. I'm very happy to do that if you've got the time. A couple of just takeaways, practical tips for you. What not to do. So don't assume you know what's going to happen. Everything can change. As negative as I've painted some of this picture, things could turn for the positive, and I still hope so. Don't make financial decisions based on the emotion. Feel the emotion and hear it. Make it wisdom, but then allow yourself to process and rationalize that before you plan out a course of action, soundboard it with someone, and then take the action relevant. And finally, don't copy what someone else does without considering your own unique time horizon, cash flow, asset position, lifestyle, level of risk, all the things that we just looked at. You can't just copycat what I'm doing or what someone else is doing because you're unique. What to focus on then? What to prioritize? So there are some things in your control, even if you can't do anything about certain asset values. You can be irreplaceable at work and worthy of a raise from your clients or your employer. This is a time where it's hard to get a raise, but if you focus on that and you do a good job at it, you will get one. Always keep adequate emergency funds on hand. Many of us learned that lesson throughout the COVID crisis, but it's more important now than before because I'm not certain that we'll have the same government support to individuals that we had in the past. We might, but you don't want to bank on that. Invest time into finding great rates for your cash. Don't just settle with what your current bank does. Hop online, do a search, have a chat with us. There are places to put your cash for a lot more than what you're getting with the majors. Keep extra cash and lending possibilities and even liquid assets available. So a lot of our clients have taken out extra loans where they're not paying anything to have the loan. It's just sitting there as like ammunition. It's just ready so that when the investment opportunity comes, because as markets continue to drop, there's better buying opportunities. It's not all doom and gloom. If anything, as an investor, it's exciting. It's like, oh, great time to buy things at the cheap. But if you're not ready, if you don't have the cash, if you don't have the loan available, you can't do that. Choose your area of expertise and keep your eyes focused on it. If you're a property person and you know a certain suburb, stay vigilant. Look weekly. It might not be inspiring because you're seeing things drop and you might even be losing money at the same time, but watch out because there will become an inflection point and you want to be mindful of where that is and be ready to take opportunity. If you don't know what your niche is, if you don't know what your stock or your crypto or your business or your property is that you're focused on, it's harder. Like you can't look at everything. You'll be waiting for your mate to say, oh, I just bought this thing. And they probably won't tell you, to be honest. So you'll probably just miss the opportunity. You'll hear people freaking out and you'll freak out and you'll realize a month later, that was probably the time to buy. Didn't pick it up. Be patient. When you're watching, you'll find good deals, but then they'll be better and then they'll be even better and then they'll be excellent and then they'll be fantastic. Be cheeky. Be willing to lowball it a bit, offer some interesting offers and see what you get back. Learn, like test your negotiating skills and look for great deals because they will definitely arrive at some point. Learn how to invest. Learn the fundamentals and technicals of investment. Learn how to read a chart. Learn how to make sense of the news. Learn which places to look online. Myself and our team really want to help educate on that, and so I want to share with you in a moment a really cool opportunity that we're going to offer to educate people on this specific skill, fundamental and technical analysis on stocks, how to know when to buy and sell using some indicators, practical things that will really help you make decisions. And finally, study the economic past and the factors that influence the economy. There's great resources out there. There's books. I use a lot of YouTube primarily. I find individuals I admire and then I hunt them down. I spent hours listening to them, taking notes, correlating their thoughts, cross-mapping them against others. It's a great medium, but there's many ways to learn out there. Finally, I just want to share this opportunity with you. So this is the Share Investing Mastermind that we've run a few times now, and we want to offer it again in a few weeks' time. If you're interested, please express interest. What we do is we get a group of about 3 to 8 participants, no more than 8. We're going to keep it nice and intimate so that everyone gets a chance to share and kind of voice their thoughts. And over the course of 4 sessions, we collaborate together to teach you how to make strategic investment decisions and get yourself invested or adjust your investing plan. So roughly speaking, this is the curriculum. We'll cover the principles and strategies of how to invest and what's happening in the macro, and you'll hear me unpack my thoughts. We'll look at charts together. We'll look at individual stocks together. Give you a chance to do the same, bring your stocks to the table and share it with the rest of the group. So you're learning with this small group. Week 2, we're more focused on how to value a stock, like what are the fundamental aspects that go into picking a stock, and then how do you find opportunities out there, stocks and ETFs. Then we'll do technical analysis. That's the charting. So what do we make of these lines, and what do all these levels and these numbers mean? And we'll teach some really cool principles around that. We'll get you guys to do that. I'll give a few examples of it as well. And then finally, help you with the practicals of like how to pick an exchange, how to set buy orders, limits, which markets, Australian, US, all these sorts of things. All the practical decisions will help you work those through so that at the end of it, if you're a beginner, you can go from 0 to something meaningful. And if you're already involved in investing or have a portfolio, you can just upskill and feel confident to be able to make your own decisions, not just rely on myself or our team or another professional to help you with that. So I look forward to the chance to work through with you and the rest of the group, the skills of investing and all the more to help you make great financial decisions over the next year to 2. If you're interested, it's a $600 one-off cost that covers the whole 4-week program. It also includes all the content that we'll provide and all the ongoing individual support. And there's a link that I'll include on the video for you to express your interest. If you've got questions that you'd like us to answer, if you've got suggestions for topics, love to be able to make more videos like this if they're useful and helpful. So reach out, don't be a stranger, and we'll look forward to chatting soon. Ciao.